Talk to Jim Fitterling. He is the company's chairman and CEO and joins us in another CNBC earnings exclusive. Jim, always good to have you. And I'd love to start off with the decision you made to cut your expense or increase your expense reduction, I should say, from what had been a $350 million target to $500 million through what you're calling additional structural cost interventions. Why are you doing that?
Good morning, David. Good to be with you. We went into the quarter looking at this as a quarter where we needed to deliver very strong cash flow. And with some of the demand destruction that had happened because of COVID-19 and some of the related lockdowns that had some parts of the industry shut down, we decided to take a look at competitiveness long term and make sure that we had the right structural costs moving forward to manage through what could be an uneven or a prolonged recovery.
Yeah, well, it's one that it's very difficult to, of course, ascertain in terms of what's coming in the future. That said, you did see improvements in Asia Pacific, but not much in North America, I guess, during the quarter, right?
We did see China post a 3.2% GDP rate, which is the first growth rate we've seen in a while there. We saw double-digit volume growth in most of our segments in China. We did not see the U.S. come back until really late May and the month of June. So from a North American standpoint, you might think of it as second quarter was a quarter with one solid month in it, which was the month of June. But our July order book looks good, and that's a good sign. And we're starting to see some sectors that had been relatively slow start to pick up. Automotive is back in production. That's good. Automotive sales are good. Housing starts are up. We saw yesterday Whirlpool announced great appliance sales. We're starting to see that pull on the appliance start of the chain. The things that have been strong, like consumer packaging, food and specialty packaging, items that are going into cleaning and PPE, those continue to be strong. In fact, packaging was up 6% year over year.
Yeah, you mentioned the July order book, Jim. I wonder, how confident can you be in that, given we've seen a resurgence of the virus in a lot of our largest states, California and Texas, for example, and certainly there is the possibility that economic activity is stalling, if not moving backwards in some of those key areas?
Pretty confident. We have pretty good metrics on the customers. We've been in very close contact with them through the second quarter. Very strong relationships there. We've been turning on a lot of visibility for them for shipments and things that are helping them manage through the pandemic. So we're in daily communications with them, and we watch order load and we watch shipments, and July looks very solid to us. And the outlook from their standpoint is for a good August. I think some of the things that are in question right now really relate to back to school in August and how that's going to play out.
Jim, it's Morgan. I know the company is generating cash from operations right now. I think, nearly $1.6 billion. There's been a lot of, I guess, concern on the street about the state of the dividend, which yields more than 6% right now. Is that payout safe?
Our priorities for cash are very simple. One, to safely and reliably run the operations. Two, to support that dividend. And three, to pay down debt. If you look at second quarter, we generated $1.6 billion of cash from operations, $1.3 billion of free cash flow, and we paid down $600 million of debt. And we've still got really good liquidity and cash on hand. We have $3.7 billion of cash on hand and $12 billion of liquidity. So we're managing through this very well, and we want to make sure that we continue to do that. We managed working capital well. We released $526 million from working capital in the quarter, and that is because we took the decision to focus on cash and not just run and put material into inventory.
The incredible drop we've seen in natural gas prices over the last couple of weeks, last couple of months, how much of a tailwind is that for Dow, and where do you expect those prices to go as we head into the second half of the year?
Natural gas is helpful to Dow because our energy costs are largely based on natural gas. Ethane and propane are our feedstocks, and so we watch ethane and propane costs as well. Propane has been low, and ethane has come back off of some of the highs of second quarter. I think the outlook is oil has firmed up, and oil looks like it will stay in this range, maybe as high as $48 a barrel this year. That means that there's going to be enough ethane in rejection for feedstocks for us, and so I think that has improved a little bit. The forward curve on natural gas is below $3 for as far out as we can see. So I think watching inventories and how much we have into storage going into the winter is going to be even more important as we move forward.
And finally, Jim, we started with obviously the decision to continue to cut costs even further. I wonder, has the pandemic forced you to do things you might not otherwise have in terms of at least how you focus on the overall business at this point? Sort of, has it challenged you in any way to take a look at your assets in a different way?
It has on the asset part of the restructuring. We've had a plan, and we've looked at our footprint that we want to have in the year 2030. And I think what it's done is it's forced us to take a look at the cost competitiveness of some of those assets that are on the end of the cost curve and just challenge ourselves whether they'll be competitive for the long term. And then we've got to also look at what's happening with trends and mix shifts in the marketplace. So we're seeing, maybe a trend away from office buildings and that kind of construction, and we have to watch public transport and are people going back into cars. And so what we're trying to do is really consolidate that footprint, make sure that they're low cost. And in our business, you've got to keep lowering your break-even cost every time you go through one of these situations. Make yourself stronger for the next time around.
Yeah, well, we understand that. Jim, always appreciate you taking some time. Thank you.